Thank you very much. Good evening, everyone, and we heartily welcome you all to the results update call of SBI Life Insurance Company Limited for the year ended March 31st, 2020. Along with me are Mr. Mahesh Sharma, Deputy CEO, Mr. Sanjeev Pujari, President Actuarial and Risk Management, Mr. Abhijit Gulanikar, President Business Strategy, Mr. Sangramjit Sarangi, President and Chief Financial Officer, Mr. Subhendu Kumar Bal, Appointed Actuary, and Chief Investment Officer, Mr. Gopi Shenoy. Update on our financial results and the key highlights can be accessed on our website. The key highlights of this financial year for SBI Life are: new business premium registered a growth of 20% and is now at rupees 165.9 billion. Individual protection new business premium grew by 42%. Non-par and ULIP new business premium has grown by 28%. Annuity new business premium witnessed 307% growth and stands at rupees 11.3 billion. Renewal premium has shown a strong growth of 25% and now stands at rupees 240.40 billion. On effective tax rate basis, value of new business is rupees 22.2 billion, a growth of 16%, and VONB margin at 20.7%. Indian embedded value stands at rupees 276.4 billion, growth of 16% on effective tax rate basis. Asset under management stands at rupees 1,603.6 billion, registering a growth of 14%. We will update you on each of these above elements in details. In the sphere of premiums, we maintained leadership position in individual new business premium. We collected individual new business premium of rupees 12.40 billion, achieving a growth of 17%. Private sector grew by 8%. The company maintained its leadership position in individual rated new business premium, which stands at rupees 97.7 billion, growth of 9%, leading to private market share of 23.20%, showing an improvement of 90 basis points over last year. New business premium marked a growth of 20% and private market share of 20.50%, an improvement of 147 basis points. The renewal premium grew by 25% to rupees 240.4 billion and accounts 59% of the gross written premium. Individual renewal premium grew by 27%. Our gross written premium stands at rupees 406.30 billion, a growth of 23%. Annualized premium equivalent grew by 11%. In the area of product mix, ULIP continues to show good growth of 10% in this year, with a share of 49% in new business premium. Non-par has shown a growth of 56%, with a share of 44% in new business premium. Individual protection business is at rupees 5.3 billion, a growth of 42%, and contributes 5% of individual new business. Group protection new business premium grew by 22%, with credit life business growing at 20%. Annuity business at rupees 11.3 billion, a growth of 307%, and contribution of 7% to the new business premium. Traditional savings business, including group savings, accounts for 39% of the new business premium in this year, registering a growth of 33%. We shall continue to grow all profitable lines of businesses. About the distribution partners, bancassurance business has shown a growth of 14% in new business premium with a share of 60%. Total number of CIFs stood at 53,096 as on 31st March 2020. Instant protection policy issuance through YONO app of SBI has covered more than 1.38 lakh lives in this year. Our extensive agency channel grew by 13%, contributing 20% of new business premium. Our total number of agents stood at 1,30,418 as on 31st March 2020. During the year, other channels, that is, direct corporate agents, brokers, and web aggregators, grew by 60% in terms of new business premium. Protection premium through online channel, that is, web sales and web aggregators, registered growth of 41%. In the area of profitability, the company's profit after tax for the year ended 31st March 2020 is at rupees 14.2 billion as compared to rupees 13.3 billion in the previous year ended March 31st, 2019. Our solvency as on 31st March 2020 is 195%. As mentioned in my opening remarks, value of new business has shown strong growth of 16% and is now at rupees 22.2 billion on effective tax rate basis and on actual tax rate basis at rupees 20.10 billion. VONB margin at 20.7% on effective tax rate basis, improvement of 90 basis points, and on actual tax rate basis at 18.70%. Embedded value stands at rupees 276.40 billion on effective tax rate basis, a growth of 16%, and on actual tax rate basis at rupees 262.9 billion. In the area of operational efficiencies, our cost efficiencies continue to improve, with OPEX ratio reducing from 6.3% in FY19 to 5.9% in FY20. Our 13-month persistency ratio is 86.1% as compared to corresponding last year of 85.10%, showing an improvement of 107 basis points. On regular premium basis, 13-month persistency stands at 83.7% and 61st month persistency at 50.0%, an improvement of 254 basis points in the latter. The total assets under management stood at rupees 1,603.6 billion as on 31st March 2020, largest among all the private life insurers now, with a growth of 14% as compared to March 31st, 2019. The company continues to drive digital expansion across the company, with 96% of the proposals being submitted digitally and 37% proposals being processed through automated underwriting. Customer satisfaction, a key focus area for the company. Our grievances with respect to unfair trade practices stood at 0.09%, one of the lowest in the industry. We shall continue to focus on our vision-backed strategies of innovation, customer satisfaction, stronger digital connect, and automation. During these times of slowdown, we continue to maintain stability and consistency in financial growth, strengthen the control environment, and ensure trust to create sustained value for all the stakeholders. Thank you very much for giving me this opportunity, and we are now happy to take any questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anshuman Dave from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, if you could, if I see the AP walk, AP mix of our products, we have done some amount of non-par business in Q4 as well. If you could give us an outlook of our strategy in the non-par business, considering a lower interest rate outlook, that will be great.
Yeah, this is Sanjeev. I think most of the business that we have done was in quarter 2 and quarter 3. In quarter 4, it has tapered off. And that too, very intentionally in line with the reduction in interest rates. So quarter 4, we didn't do much of individual non-par business. When I say individual non-par, it's I think you will be referring to the product with the guarantees that come with the product. Going forward for the next year, I don't think this will be one of our staple products. Like last year, we did a fair amount of business compared to the previous year. But again, I think next year, looking at the situation, we'll be kind of moderate on this product. I won't say we'll totally eliminate it, but again, we'll be moderate. And then this product requires hedging mechanism and then the availability of that. So it, to some extent, would depend on that as well.
Right. And sir, the negative economic variance in the VNB walk would largely be due to this product?
Yes, that is one. So there are, in terms of negative economic variance, I think we are talking of the assumption, the RFR assumption, where we get hit because of this product. To some extent on the FLC product also, to a small extent. The annuity we were able to reprice at a quick time, so there was no issue on that.
Right. Thanks. If I have more questions, I'll get back in.
Yeah, sure.
Thank you. The next question is from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Hi, sir. Thank you for taking my question. Can you provide us some color on the growth outlook and for this quarter for 1Q FY21 and what our strategy has been in terms of trying to grow the business and which products can move and which cannot. So some sense of there.
So what I would say is that times are uncertain. There's a lot of ambiguity in terms of what is going to happen, what is not going to happen, and the economy is certainly at the moment a standstill. So the first quarter is going to be a little lower than what has been done in the previous the first quarter, but certainly we have ambitions to show growth. So we are not committing to any number at this point in time with you, but certainly we'll be happy to show some sort of a single digit growth. Now that single digit could be whatever, but certainly we are still confident that a growth even in these difficult times is possible to be achieved, and for that whatever changes in terms of the offerings and pronounced selling of a certain kind of product which could be suitable for these circumstances, it will be the way forward for the company, and certainly the digital route as well with SBI, which is the YONO application, our own website, and our field force engaging in a digital way with the customers, so that if a face-to-face contact is not possible, certainly we can communicate and influence the customer, explain things to him, and get our sales through. So I would request Abhijit to please add on to this.
Just to add, I would agree that first quarter will be low activity period. So only from second quarter would we see how the economy picks up and how we are able to do sales. Having said that, there are various measures being implemented by the company to meet ambition of showing a positive number over risk, that is FY21 positive number over FY20. But at the moment, too early to say how it will pan out. Second thing I would want to say is we do think that protection will continue to gain customer preference, and our emphasis on protection will continue in the current year. And there we do think that we are quite confident that we'll be able to show significant growth over the number we have shown in FY20.
Right. And on the cost side, how much, what can we do? What are our plans over FY21? How much, can you talk a little bit about how much is fixed and how much is variable and how much can we control the fixed costs so that our margins are not severely impacted? So how do you think about that?
Sangram?
Sanjeev, can you please tell? Okay, just to give you the perspective, we are currently, if you see, the OPEX is under very much control, and this is the right time for us. We have to invest, and we have been investing a lot in our infrastructure as far as the IT and our processes are concerned. And what we believe is that at this moment, we have already started putting a lot of infrastructure in place for training of our agents and through digitally. So we will be putting effort on the expense side, and we are not at all at this moment the status where we are in the OPEX side much worried. The position we believe that which are conducive for us to increase our growth will help us through the expense to little extent. And overall, what we have decided that this year will be morely focused on digital, and there are a lot of steps have already been established as far as the frontline sales is concerned, and we'll continue to do that. And we don't feel any issue at all from the overall expense side at this moment, and we will evaluate and we're monitoring it very closely, and we'll see how this is going to span out for next 6 months, and then we'll see.
Look, SBI Life already has the lowest, one of the lowest cost ratios, which is 9.9% overall, 5.9 on the OPEX side, and 4% on the commission side. Now, we have the highest number of branches, the SBI Life branches, 930 odd. So certainly, our presence is well diversified. We are well entrenched in every part of the company. So we can certainly look to, if we decide, if we feel, going forward, that this is an area where we need to curtail or we need to make that investment, we'll decide accordingly. Areas where an advance decision has to be made for the year, that is what we are doing. Where over an evolutionary period, certain expenses have to be curtailed. Certainly, we will do that, but not something which is going to lead to business, which is leading to capacity expansion. So, it will be all about judging the situation as we go and then taking steps which are possible to be taken at that point in time. So, in these circumstances, nothing can be cast in stone, and it will always be a flexible shifting position depending on how things are panning out. Sanjeev, you were saying something.
Yeah, I think almost entirely same is whatever you were saying there. What I was saying is, at this point of time, it's too early to do anything which disrupts the current business model. For example, we kind of lay a focus on agency channel, which is considered to be expensive. So we continue to lay focus on agency channel. And then going forward, depending on the situation, how to what extent, over what period this situation continues, possibly we'll have to take a call subsequently. But again, at this point of time, or maybe towards the next quarter end, I don't think any sensible decision can be taken regarding radical changes in the business model. Now, having said that, whatever we have been doing over the last 2-3 years in terms of digitalization, in terms of usage of IT, all sort of automation and all those things would continue unabated. So that is not going to change.
Just one last question. The provisions for on investments have increased considerably. So in FY20, the total number is about 130 odd crores.
Yeah, 130.
Yeah. So can you give me a breakup of that and maybe also let us know if there's any outstanding stressed exposures still left?
Yeah. Gopi or Sangram, anybody?
Yeah, for the year only, as far as the stress assets are concerned, we were having only the DHFL, which we have already spoken about, and it is fully provided. And at this moment, we don't see any issue on our exposures are concerned. And as and when the situation will arise, we will take a call appropriately. So we don't see any issue at this moment because 92% of our portfolio is now above AAA bonds. And we are very much comfortably placed at this moment. So we will see how the situation will arise.
And can you give a breakup of that 130 crores?
We will come back to separately. We'll come back to separately on that.
All right, I'll get back in the queue. Thank you.
Yeah.
Thank you, ladies and gentlemen. In order to ensure that the management will be able to address questions from all participants, we would request you to please limit your questions to one at a time. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. The next question is from the line of Qtr4 from BNK Securities. Please go ahead.
Thanks for the opportunity. Sir, my question is with respect to ULIPs. We have reported a lower fall in Q4 in comparison to competitors who have released their results. What are we doing differently? And do you think this difference should continue in FY21 as well?
Yeah. Can I take this?
Yeah.
So
in ULIP, one is, in terms of debt, the component of debt is higher than equity. You must be aware that the bond fund which we have is the highest in terms of value. It's a 22,000 crore fund. Last year, we have gone through all the pains in terms of owning mid caps, because if you look at year before last, mid caps were doing well, and last year it went through the pain, and we reduced our exposure to cap to a large extent. So just to give you some numbers, it was 20% plus, and we are now at around 6-7%. So this has helped us significantly in terms of outperforming. And we held to our view that things were actually looking very expensive, and we tried to be as near to the benchmark as possible. And in terms of outperformance, we thought that within the benchmark stocks, if we are tweaking the weights and trying to outperform, should be good. So net to net, the answer is debt has helped us. Debt is not actually moved anywhere. The component of equity, we were very cautious in terms of what we are buying, and we tried to be more defensive. This is what has helped us compared to the index and compared to competition.
So I was more talking on the growth aspect. ULIPs have degrown by only 14% in Q4, whereas the competition has put it close to 40% kind of dip on AP.
Okay, you're talking about the pre-AP. Okay, that I think
growth. Yeah. Abhijit?
No, so for us, we have continued to sell ULIP. It continues to be a profitable product for us. And given our mix, our customers are comfortable with what they are buying. So we don't see any reason why we should curtail ULIP growth. If customers is buying and it is a reasonably profitable line for us, we will continue.
Yeah, that is one. To add to that, I think we have got a satisfied group of ULIP customers. Possibly they understand the business pretty well, the product pretty well. So there is focus on a mix of debt and equity. That is number one. If you look at the surrender ratios that we have on ULIP, it's by far the least in the industry. It's fallen from 5.2% to 3.9%. That is, if you ask me, that is some testimony to the kind of customers we are selling to. It's not necessarily elite customers or high ticket size customers. We sell to customers across the country of all profiles. But again, I think we are doing well as far as the ULIP sale is concerned.
Perfect, sir. So just a question on protection rate hikes. We haven't taken any hike yet. So will our margins be impacted going forward?
Yeah, I think that's an interesting question in the sense that after the hike from other companies, the rates, we are close to our competitors' rates. So essentially, we are, marginally costlier than SBFC, and then we are cheaper than ICICI too. So all along, we are selling protection at a substantially higher rate. After the repricing from other companies, we are more or less on par with the major peer companies. What we'll do is we are planning to enhance the product features. We are waiting for the rates to come through in the market, which have done that. We are waiting for the reinsurers to spell out their revised rates. So we have got that. So there will be some feature enhancement in our bucket of protection products. And then we'll align the rates marginally. It doesn't require a great deal of alignment. So profitability margins are not going to be impacted at all.
Great, sir. Thanks a lot for that. Thank you.
Thank you. A reminder to the participants, please limit your question to one at a time. The next question is from the line of Nidhesh from Investec Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, on the EV walk and VNB walk, if you can explain the change in operating assumption, what is causing that, and why it is positive on EV and negative on VNB?
Yeah. On the VNB, if you look at the walk, there is an improvement because of mix, which you would appreciate comes from greater protection, more amount of individual non-par that we sold. So it's about the product mix. On the assumption, not a great deal of change, other than there is a provision of additional CRNHR in in the assumptions that we have today. So the current assumption would carry roughly around 2 to 2.5% of the AP as additional risk margin provision. That is for the risk that we see in the coming year. This is a risk of higher acquisition expenses, the risk of overall higher expenses. I don't see there is a great deal of that will happen on the claim side, maybe marginally. But again, it's mostly expenses, not because we'll be spending more, we'll be spending less, but because there is a likelihood that the business volume would go down. So this, the impact of 1.3% negative is entirely because of that. And there are a few components regarding assumption change, like persistency moves a little bit here and there.
And what is the assumption change in the EV box, sir?
EV box, again, the routine assumption. It's like expenses do change because we always move on to the actual expenses. There will be changes in persistency, adjustments here and there, that kind of thing. So it's a mix of whole lot of things. But again, nothing very specific that we had to change, one particular assumption a great deal because of that. So it's basically a continuous evolution of the assumption. There is nothing really spectacular, and the number also is not great. I don't think it's a big number. It's a small number only.
Yeah, and so going forward, whether we should look at effective tax rate, because going forward the tax rate benefit we are not going to get of the dividend income. So whether we should focus on effective tax rate EV or without effective tax rate EV?
My point of view here is that different people would have different point of view. Remember, in my point of view here would be that for this year, because what happens is there is an effective tax rate available for this year, 1920. So as of March 20, there is an effective tax rate. But then if you carry that to 2021 with Section 80M coming in, and then we are not paying any dividend this year, so obviously the effective tax rate is the same as the actual tax rate. So theoretically, that is the position. So what we have done, if you see our presentation, we are presenting the main numbers, the basic numbers as on the actual tax basis. But again, down below we have given a comparison that if you use the effective tax rate, we are not calling it the basis. If you use the effective tax rate of 1920, this will be a EV, and that is for comparison. Now going forward, a lot of things depend on whether we'll pay dividend next year. We didn't pay it this year. For what kind of the dividends we'll receive, the investment mix and all those things. There are a whole lot of uncertainties, but again, the major one is the dividend payout. Because today the tax relief would depend on how much of dividend that we pay. That is an uncertain situation at this time. Maybe 6 months, 9 months down the line, when things improve, the future prospects look good, then we'll say, okay, we are back on track as far as dividend payment is concerned. So that is the uncertainty that we are facing at this point.
Sure. And then lastly, sir, if I look at Q4 performance, our 9-month performance was pretty strong in terms of protection growth, AP growth. But if I just look at Q4 number in terms of premium protection, the YOY numbers are quite flattish. So what is the reason for such subdued performance in Q4?
The Q4, the volume overall itself has taken a hit because of March. No? Impact of last 15-20 days of March not being available, primarily.
Okay, because I think the protection was even slower in the month of Feb, because if I look at the monthly numbers, where the sum assured growth for the month of Feb was also quite subdued. So I was just wondering whether protection had started slowing down earlier, or it is just last 10 days impact.
Last 10-15 days impact largely.
I think it's a March impact that we see largely.
Oh, okay, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Qtr4 from Spark Capital. Please go ahead.
Yeah, thank you for the opportunity. Just in the EV walk, persistency variant around 240 odd crores compared to 5 crores of last year looks on the higher side. Just wanted to understand whether we have significantly, did we change anything with respect to assumption changes with respect to persistency? And I just also want to know what exactly we building with respect to persistency. In BRSP, we mentioned it is a rolling 3-year average. We are still sticking to it, or we actually punch the real experience what we realize in the year to calculate the persistency related impact on EV and VNB?
No, across the major segments like ULIP and PAR, individual non-PAR, we used to get a significant persistency positive. We used to get that earlier also. We used to get a knock on basically the group GTI and other, because we used to assume a 3-year business, and it's a renewal, 1-year renewal kind of business. The schemes that would not renew, we used to take them as lapsed, non-persistent. What change we have done is basically that we now are assuming the 1-year business as 1-year business, so the persistency impact doesn't come. So earlier we used to get positives, but again it used to be knocked off, offset by some segments. So that is all.
Okay. And just can you break down that 700 crore economic variance into equity, bonds, and DHFL?
Yeah, I can do that for you. The debt mark-to-market and equity mark-to-market virtually cancel each other. So equity mark-to-market 990 crores negative. Debt we have got a positive of around 915. So overall on the mark-to-market side we are getting a net 75 crores negative. And then we have the usual revenue account investment surplus of around 560 crores. The shareholders get their profit, which is around 400 crores. There are a few other things, changes, second order changes, which is around 500 crores. So net, that is what we are showing, around 710 crores odd. The economic assumption change, that is the change of the yield curve, is around minus 1200 crores. So that is a big component there.
Okay. And then when you say bond 960, it includes DHFL also there?
No, this is all mark-to-market. DHFL, whatever provision is there, that would have already flowed through the profit and loss account. So that is already there. So this is apart from that.
Okay. And sir, this one wanted to understand, given you don't want to focus on non-par going ahead, given the guaranteed interest rate cycle, and probably the demand could be lower compared to what it was last year. Then just wanted to know, given we are confident of delivering a single-digit growth even in this environment, which product will drive growth, and which channels will you see that kind of a growth, basically, and how just wanted to understand your overall broader strategy, why you are confident that given non-par also not there, you taking a knock due to the low demand, the growth of around the low single digit is still possible for you.
See, let me go one by one. PAR have shown the growth over last couple of years. I think if people are uncomfortable with ULIP, the PAR could make a little bit of comeback. On non-PAR, we are saying that we will, if the customer is willing to buy, we are happy to sell. We have already repriced the product for low yields. And if required, that is from this May, it will get repriced. If required and interest rate go down further, we will reprice. So we will reprice as per whatever is the market requirement, and if at that rate customer is happy to buy, I think we have no challenges in selling the product at that level. Plus, as you have seen, our ULIP continues to do reasonably well. We do think that if people, after the activity starts in second quarter, there could be some sales coming from there. Broadly speaking, what we are saying is we will see significant growth in protection. The remaining will depend on how the market pans out and how what customers want to take, whether PAR, non-PAR, or ULIP. As far as channels are concerned, we have one more big tie-up in terms of UCO Bank, and there are more which are coming for tie-up, but probably this year may not contribute significantly as they could come in second half of this year. But SBI and agency, both our main sales channels, if we could get, and we are not guiding, a marginal positive growth, we should be happy if we would get a significant growth from the new tie-ups that we have over what we have got over last 12-15 months, plus UCO Bank, which we have just got.
Got it. So basically, the substitution between ULIP and PAR is quite possible to your customer base, basically. That's the way should I look at it?
Correct. Yeah.
Okay, and just a bookkeeping question. Group protection, can you break it down into credit protect and GTL for the current year and last year?
Group credit protect is roughly 1,300 crore single premium, 1,350, and remaining is GTL.
Okay, perfect. And last year, if you can tell me
similar number, 1,350 only. Last year was lower number, 1,200 crores roughly on credit protect.
Look, I'll give the numbers. Individual was 371 last year. It is 529 crores this time on the NBP basis. 1,130 crore was rate life last time. This is 1,351. 142 was GPI last year and this 202 crores this year. Total, you can add it up. It's somewhere around 2,000 crore plus. 2,000 this year. Against 1,640 last time, 27% growth.
Okay, perfect. That is good.
Yeah.
Thank you. The next question is from the line of Sumit Sariwala from Morgan Stanley. Please go ahead.
Yeah, hi everyone.
Hi.
I've got two questions. One is persistency. If you can just give some the regular persistency number, if you can just share for ULIPs and protection, please.
I thought you have that regular.
Sumit, can we come to you offline on this, please?
Okay. And the second question was operating assumption change. Did you share some color on that? What drove that this year?
Operating assumption change.
Yes, Sandeep shared for the last question we answered. The last question, I think last question.
Yeah, I mean, if you're talking of the VNB walkthrough, so there I'm saying on the VNB, it's mostly coming from, there are a few changes, not radical changes, but again, on the VNB, what you see that 1.3% negative is mostly because of the increase in the CRMSR. That is the risk provision that we have done for the following year. We see additional risk of maybe expenses rising or persistency falling. So that is the major component there. But again, there is no severe changes on the operating assumptions anywhere else.
I'm talking about the embedded value movement. So in that, there's a positive operating assumption change of 1.2 billion, right? That what is driving that?
So if you see slide 27 or 28, we have given the breakup.
Yeah, so the assumption changes are there, pretty much there.
Okay. And last question. So operating experience, variance, there is other category of 1.9 billion. Any color on that? That's quite meaningful this time.
Operating
variance, in the others category, there is a positive variance of 1.9 billion.
Yeah. That is a mix of many things. I mean, you would have, just a moment. You would have reinsurance, you would have revival, you would have a whole lot of things, small things basically. You would have some mismatches of numbers. So those kind of things would be there. You would have basically change in the crediting rate also sitting there. So there are around 8-10 items which contribute together. Then you would have the provision that we do for statutory basis, global reserves and all those things. So a lot of things, small amounts put together would give rise to that kind of thing. There will be a number of things. But again, you won't have anything major there. I think the major thing that sits within the other operating variance is the release of the margin. The major component is that. If you look at it, other things are very small. And when I say release of the margin is whatever is provided for the CRMHR last year as a risk margin would not actually come through this year. So that is a release that we get which sits within that other operating variance.
Got it. And any color with respect to persistency trends in the month of March and April?
Sorry, persistency?
Any color on persistency trends in the month of March and April, please? Because the number that you have given is as of February, right? Like what everyone does.
Claims? Sorry, I'm not getting it.
Persistency.
Persistency.
Okay. So the persistency numbers, we do think that there has been a little bit slowdown in the month of April as far as collections are concerned. We have broadly hit our targets, but slightly lower than what we would expect. But we will have to see as we go forward whether this trend will continue or what. We will be able to give a concrete comment only by June.
Yeah, I would say, yeah, carry on, please.
What we can add it over here, as you rightly said, that February data we have seen as a March is persistency. But however, about the March persistency or April persistency will be taken care by the other factor. As you know, the regulator has been comes out with the extension of a grace period. So basically, if you calculate it today or tomorrow, it can really getting change on this line. So what Abhijit has said, possibly at the end of the quarter, we may have the exact clarity that how the things are moving on. Because this is the part everybody knows current situation. people are getting, instead of 30 days, they're getting 60 days time to come back to pay their premium. Though other parts will be there, obviously affect the overall salary, all the things will be impacted. But having said so, they are having more timing. So if you calculate as of today, maybe still it can go little beyond also. So either you have to take this of 60 days into calculation, or you have to wait for some time to see it how it improves.
On a broad basis, what I would apprise you is that the target that we had set for renewals for the month of April has been achieved by us. It was a little lower than what we would want because we wanted more, but the target was exceeded by us in the month of April.
Sumit, just to give you the numbers which you asked in the first question, the ULIP persistency is almost same as of last time. So we are at around 85 plus. And in the PAR, there's an improvement. We are at now 80 plus. So both we have seen an improvement.
Got it. Thanks a lot, Sangram. Thanks a lot, everyone. Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to understand, there is a fairly sharp dip in our solvency ratios on a QOQ basis, almost 35 percentage points. Just wanted to understand the breakdown of that, and also considering that the worst is yet to come in 1Q, where do you think we are on solvency going ahead?
Just for a second. So what I try to say, if you look at that part, you are rightly said, as of December versus March, if you look at it, overall market has fallen. So because of that market fall, your asset value and every ASM will be a little bit impacted. And that is not true for only SBI, right? That is true for the possible, almost all the companies that are like that. Not only it depends on your business mix, because different business has the solvency factor, what you do as per the statutory solvency. All of you must know this is the factor on this. So factor in the solvency based on the which type of product. So accordingly, solvency has to kept on. So we are doing little bit more protection business. Also, our business growth is a little bit around 10-20%, whatever we are doing it. So put together, all the things put together, and because the market fall, your asset value falls, obviously your solvency will be disturbed to that extent. And that is the only reason for that. But having said so, I say that being so much of depth on the market down of the equity as a base, which is directly hit for both the unit policy as well as the non-par policy, still our things is around 1.95. So if you look at for last 2-3 years, our company having around 2 or so little bit of half here and there, around that only. So having all those parts put together, it's 1.95, which is much higher than the possibly your regulatory requirement. So yeah, the main reasoning for this down is nothing but the only ASM down to that extent, and also the business mix and new business strain as it should supposed to happen.
Okay.
To bring to your knowledge, and you would be already aware, the regulatory norm is 1.50. Of course, our board declares a higher this thing. But even when, March month, in the month of March, many life insurance companies had made a representation that the solvency ratio should be either brought down to 1 because the equity markets are falling. So, in terms of cushion, we have the available cushion, and if at all something needs to be done as a coping mechanism, certainly we will be open to those coping mechanisms.
Great. And secondly, on protection, right? If I understand it correctly, a large part of your retail protection policies are ROP, and probably one of the reasons why pricing also is higher because there is some bit of savings baked into that. So when you say that, you're basically going to wait to see how the pricing settles and as a result decide on your protection policy. Just wanted to understand, how are we managing the margin on that front, considering the product mix that we sell versus some of the peers sell are different?
Here, any repricing here, we are talking in terms of the peer protection. So that is the individual term business, not the ROP business. ROP business, I think the way it is priced, in any case, we return the premium in the end. So we are kind of okay with that. It's sufficiently acceptable. What we are trying to push is the pure protection, and then whatever has happened, whatever has transpired in the last month or so, in the month of April, would help us because the rates generally in the market have gone up by around 15 to 20%. So that rate of the peers come pretty much close to what we have today on our existing business without us doing any kind of repricing. So in that sense, it protects our margin. And even if we change the rate, it will be very minor, just a tweaking or trying to align with the rates in the market, or maybe making the long term a little bit cheaper so that we see the profitability coming through. So that is basically all. So that is where the focus as far as repricing is concerned. On the ROP, we are comfortable there. So whatever we are getting, we are okay. There is no repricing required.
So what is the mix of ROP versus pure, and how much do we reinsure as a proportion?
For protection product, around it depends on the kind of product, but again on the large ticket size products, we would be insuring somewhere around 70 to 80% of the business, or at least 60% of the business there.
Okay, and split between pure and ROP?
I think for banker it is pretty large, but again if you take overall, I think it comes to, Abhijit can correct me, around 80% as ROP.
Yeah.
Correct.
820, yeah.
Thank you.
Thank you. Reminder to all the participants, please limit your question to one at a time. And we would request you to join the queue for follow-up questions. Thank you. The next question is from the line of Mr. Qtr4 from Qtr4 FY20. Please go ahead.
Yeah, hi. Hi. So you've been sharing or discussing this in the past. So just wanted to check what would be the VNB of the protection business?
VNB on the whole, because we have got a mix of the spectrum is pretty large from this end to that end. On one side we have the ROP product. It's a protection, but again with an element of investment. And the other side we have got credit life. So on the average, if you take it, it falls somewhere at around 70-75% for the entire set of products.
Sure. The other thing was on the effective unwinding rate. So the impact of movement in interest rates this year should get reflected in the next year's discounting rate, or should it get reflected this year itself?
It's a theoretical position only. In practical terms, it doesn't really make much of a difference, because if you see the unwinding rate, what we have taken this year as 8.5, that would appear at the top of the analysis of movement. But subsequently lower down, that rate is adjusted to eventually the actual rate for the movement. So that is how it goes on every year. So we might decide to, because going forward, possibly the interest rate would come down. So the best estimate rate will go down from 8.5 to 8. But again, what really matters is what rate you actually earn during the year. So, and that is in essence what comes through. These are all just presentation.
Sure. And just one thing, you gave the breakup of economic change of 710 crores. Maybe I think give that piece by piece once again, please. Thank you. Yeah. So if you could just give that piece by piece once again.
Okay, once again. Okay, sorry. I didn't get you. Yeah. The debt mark to market is 900. I'm just rounding it up.
Sure.
900 crores. Then equity mark to market is around 1,000 crores. So net we have a loss of around 75 crores. We get an investment surplus in the revenue account of around 550 crores. Then shareholders earn 436 crores. So take it as 430 crores. There are a few secondary items. When I say secondary items, investment income has a bearing on the unit-linked business going forward, because the FMC would increase. So that is roughly around 500 crores. If you take that, it comes to around 475 crores. All these items that I've said. There is a 45 crores miscellaneous. You can leave that out. 475 crores. On the assumption change from the change in the yield curve as on March 20, that is a negative of around 1,200 crores. So roughly it comes to around 700 crores.
Sure. Great. Thank you.
Thank you. The next question is from the line of Deepika Mundra from JP Morgan. Please go ahead.
Hi, good evening, sir. Thank you for taking my question. So firstly, on the sensitivity part, I noticed that your sensitivity to NBV from interest rates is significantly higher at the end of the year versus what you reported, I think, last quarter. So any specific reason for that? And just to re-clarify on persistency, I believe you mentioned that the improvement in ULIP was minimal, so ULIP remains largely flat, yet we are seeing persistency basically improving across most of the major cohorts. So what would be the key driver of that persistency improvement?
Persistency improvement happens across the board, all the products. So ULIP improves, the other products also do improve along with ULIP. So the improvement is right across all the products. So it's not confined to any single product at all.
Okay. And sir, could you clarify on the sensitivity bit on interest rates for NBV?
Okay, I don't think there is any major change except I'm just trying to look at the slide. It's could be business mix. If it is increased, it could be because of the smart platina, the individual non-par product. It could be because of that to a great extent, because that is the only product where the proportion has increased significantly.
Okay, got it. Thank you.
Thank you.
Thank you. The next question from the line of Udit Vadia from Khazana National. Please go ahead.
Hello. Thank you for the opportunity. FY21 is likely to be a challenging year for the bank. So maybe the focus of SBI's management and even employees could be on collection vis-a-vis growth or cross-sell. So how do you guys foresee things there?
Abhijit, to say anything?
There would be a challenge. I don't deny that, and that is why we are saying that it is extremely difficult to give guidance at this moment for the current year. Of course, we are working out new innovative ways with SBI to reach out to customers. We do think that we will yield soon this year.
Yeah, I think I'll second your point that the collection of premium would be a significant activity during the year, because at whatever cost, the persistency has to be kept up.
Okay. And how much proportion of the customers have opted for the grace period during the month of April and May? And how has been the customer psyche over there?
I don't think anybody has been applied as such in a formal way, but that is already being communicated to almost all the customers. They are having, as per their policy, due date, and if we add the grace period and another extra 30 days is given for month of March and April. So nobody has been really as such comes out in this line. But as I said, indirectly, as you can say that what our MD is saying, that our renewal premium is coming roughly similar lines, means that is what is expected to come. That means it looks like that people may be taking some of them and some of them may not be taking still now. So that's the way it works actually. There nobody is required to come and tell that I want to take this particular features. So and maybe we can give this number later on by getting in touch with our operations department.
No, I think the only reflection indication of that we'll get is whether the collection in the during the grace period is slowing down. So are we collecting less? So in that case, we'll understand that people are using that facility. So typically we have around 60% of the people paying during the grace period, 60-65%. So that is something that we'll have to see as the grace period gets over. No. So essentially, in any case, after the grace period, the policy lapses. The policy in our book actually lapses after 6 months. But again, the death cover ceases. Here, the additional month is available to cover provide the death claim also during that period. So that is something that number will come through gradually. We won't get to know so early.
And lastly, on protection margins, do you foresee it going down in F21 given it's at like 75% in F20?
No, there is no reason why it should go down unless we see large number of claims coming through or the experience is deteriorating, and then I don't see any reason why the death claim experience would deteriorate. I mean, in spite of COVID or whatever, I don't think our portfolio would be significantly hit because the number of claims that have come is very minuscule directly as a result of COVID. So it's not going to impact. And we don't anticipate a big repricing in terms of trying to lower rates. So that is also not on the cards. The rates would virtually remain the same because that is where the market rates are today.
Okay, great. Thank you.
Thank you.
Thank you. The next question is from the line of Anirban Prasad from Principal AMC. Please go ahead.
Yeah, my questions have been answered, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Kush Tandon from Edelweiss. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. Sir, first of all, it's great to hear that you are still running for growth. My only question is, with the insurance being such an intermediated product, and if the channel is not functioning for 1 or 2 months properly, and digital being a small portion of our business, how are you so confident of growth in NBP in the first quarter? And also, sir, what would be your experience of April numbers be as compared to last April, year on year?
I think when we said that we are looking for a single-digit growth, we do not say that we are absolutely confident that what we are saying is we are still pitching in for some growth in our budgeted numbers so that the sales force feels that, an attempt has to be made. In these, times when they are uncertain and, you don't know how things are going to pan out, certainly an element of suddenness or surprises will always be there. So we are not saying that we are absolutely confident. We are saying that we are moving on the premise that an element of a single-digit growth should keep the momentum going for our people and for the company. And if things improve and if there's a ray of, positivity in the economy, etc., we could perhaps still feel that growth. Right?
Understood. And so, in terms of April numbers, do you be able to give the kind of productivity or any productivity that you are seeing currently in the channel?
Can you please repeat it? A little muffled voice.
So I was asking about the April business, sir. As compared to last April.
April growth was not up to the mark because it was a virtual lockdown, and it is only now that in the last 5-6 days that we have started opening branches on the ground. So I would say roughly 200 odd branches out of 900 branches have now started functioning. So there has been a lockdown, there has been a slowdown, there has been real worry among the sales force, and we kept the interest, the health angles of our workforce as a top priority. So naturally, things were not usual in the month of April, and there has been a dip. But now we are certainly moving back into our arena, and we will see how we can, make things moving faster.
Sure, sir. Thanks a lot. That answers my question.
Thank you.
Thank you. The next question is from the line of Mayank Buswediwala from Franklin Templeton. Please go ahead.
Hi, sir. Thanks for taking my question. And sorry, I'm going to belabor on that investment variance again. The reason I'm asking the question is, if I look at your sensitivities that you had published even now or earlier, a 3.6% increase in EV on 1% decline in rates and a close to 1.4% decline on a 10% decline in equity value. So the 700 crore based on just the table does not really add up. So just wanted to get a sense on what we are missing here.
No, I don't think we are missing anything. 700 crores is all taken together. So you have got positives, you have got on the debt there is a capital appreciation, on the equity there is a capital loss. And there are other components, positives also there. So if you're looking at 700, it's the net of around 6, 7, 8 different items. So there is the income from shareholders. They all are bunched together in the economic variance. So that is basically the value add from your investment activity. So there is no single component. It's around 5, 6 components, and that is why it's coming through like that. So equity loss is roughly around 990 crores. Debt gain is around 960 crores because the yields have gone down. So we have gained on the debt side.
All of that is on the shareholder book, is it? This 900.
Yeah, all of this is on the shareholder.
So then I remember in last time when someone asked this question, you said there is a negative 1,200 crores from a change in yield curve.
Yeah. So that is for the future assumption that hits the future profit. So that is not on the net worth. So that is all the future profits. But again, the future profits at a a different yield curve, a lower yield curve, gives you a hit of around 1,200 crores negative.
So my understanding was that on MCAV, when we sort of decline, when we lower the interest rate, that should lead to an increase in the present value of future profits, right? I'm just trying to understand this point as to why the decline in yield curve has led to a decline in profitability, decline in the value of future profits here.
Yeah, that is what you said. If the yield goes down, so it depends on different segments. Different segments behave differently. Like say, if you take ULIP, it's very insensitive. Possibly you get a positive if interest rate goes down. But again, if you see the major traditional investments, whether it is the individual non-par, the participating, or for example our group saving, they are very sensitive to the interest rates going down. When the interest rate goes down, then you lose because these are spread business. The less you earn, obviously, your profit coming from the spread reduces. And then what we get on the movement of interest rate is a mix of this. But for our portfolio as a whole, which is different to other companies' portfolio, we get a negative when the interest rate goes down. And that is what is reflected in this 1,200 crores negative.
Understood. Got it. So, thank you so much. Just one more question. Yeah. You had indicated that on the VNB this time, you have taken more stricter assumptions around the cost of residual non-hedgeable risk, which is part of the reason why your operating assumption change is negative on VNB. Yeah. On EV, have we reflected those same adverse or more stress assumptions on the...
on the EV also it is there. Yeah.
On the EV perspective. Yeah. Okay, got it, sure. Thank you so much.
Thank you. The next question is from the line of Prakhar Sharma from Jefferies. Please go ahead.
Good evening, everyone. I just want to, confirm this part. I'm actually, for this year, you have reported approximately 20% growth in the new business premium. And if I look at your VNB flow, basically based on the volumes only, there is a 10% growth in the VNB. There are adjustments from a mix and then operating assumptions, etc. So I'm just ignoring that. I'm trying to compare that you have a 20% growth in new business premium and a 10% growth in profit X of mix change, X of operating changes. In which segment are you seeing compression in margins?
No, here nothing happens because this is on the basis of APE, not NBP. So it's the APE growth which comes through because the margins are calculated on APE only.
Right. So that number is also like 16-17%, right? The APE number growth?
APE is 11%.
Number growth, 11%. 11% growth. Yeah, so that is
11%. 11%.
11%.
Sure. And this, just to reconfirm this VONB level economic assumption changes of 270 odd crores, this is mostly risk-free returns, right? This is not to do anything with the investment values and all.
No,
so,
just risk-free.
Okay. So since then have, at a portfolio level for you, have yields gone down even more? Because this would have been till March 31st only, right?
It's the market rate available on 31st March. So after that, I don't think the yields have moved a great deal.
Okay. Sure. That's it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Hitesh Gulati from Haitong. Please go ahead.
Yeah, thank you for taking my question. So I just wanted to know the new business strain number for FY20 and the contribution of protection to it.
I have got for 20, the new business strain is around 2,200 crores. For protection, I don't have that number. I'll have to dig it out separately.
Okay, and just approximately this will be largely protection and ULIP. Is that the correct understanding?
ULIP will not be much. Protection would be a significant part of this. Maybe if you take almost 50% would be protection possibly.
Okay. Thank you, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Aras Sanghoy from VT Capital. Please go ahead.
Hi, sir. Thank you for taking my question. So I just had two questions. My first question would be, so have you done any kind of scenario analysis on your portfolio? Because given that we have a significant component of non-par, do you feel that any going ahead, if anything deteriorates, our solvency would be hit further?
Not really. We have done some of the initial analysis, but as we have already discussed, our non-par portfolio, if you look at it, there are only two types of product mostly, or better to put the three types of product. One is the pure protection product, which is not so much of sensitive in the interest rate. Second one is the smart platina types of product, where we have little bit of interest rate guarantee product, but it is already been, to a certain extent, we hedge it and so limited business. And third one is the return of premium product, which is not also that much sensitive. So to that extent, as your non-par product is concerned, that's not much more impact other than the overall protection business have the more new strength. So overall solvency part, as we have said, if you do the similar line, as you can see it, as we have already discussed, last year 2.13 has become 1.95 current year. So the similar types of business mix has taken that much of hit on the solvency. But having said so, we are already become good strong business, we are doing it. So some of the business mix, though protection business increases, your other business like relief and all other business can have the lower requirement of the new business strain. So those, how it will be figured out, how it will be related to the similar types of business mix is there are not much more effect on the solvency. No doubt the market, how it behaves tomorrow, how the persistency or other things come, that can little bit impact. But as of now, what we have been already internally, very broad way to do it, we don't have any concern about the solvency currently.
All right, so my second question, so again, just one clarification on the sensitivity part. So I assume like a couple of quarters back when we were discussing the sensitivity, I remember you all mentioning that as the hedging instruments are going up in India, our sensitivity to that part, specifically the group funds business and all, should reduce a bit. So since the sensitivity part of VNB to interest rate changes have increased, can we assume that you are facing some problem in finding the correct hedging instruments?
We do have hedging instruments. Either it will be a derivative, the forward rate agreement, or it could be a partly paid bond, which would kind of replicate the liability on the asset side. So we have taken recourse to the partly paid bond. On the forward rate arrangement is something that is a work in progress. It's ongoing at the moment. So if we can put that through, then we'll have the necessary hedging. I think otherwise internally, in terms of processes, we are prepared with all the necessary SOPs and policies and approvals. Everything is there on board.
Yeah, just going ahead, we might see some kind of dip in the sensitivity. Is that the right way to think?
Dip in sensitivity? No. I mean, if you are properly, adequately hedged, then obviously sensitivity would reduce. So the concern is if you are not hedged, the sensitivity will go up. So either way, I mean, if you are covering your risk, then the sensitivity, you would be insulated from the interest rate changes. So that is how it will be.
All right. That's it from my side. All the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Just one question on the protection margins. You said that we are in the 70 to 75% range. Has it changed materially from last year?
No, it has been very, very consistent.
It has been consistent. Okay. And secondly, on the agency channel, what is the strategy going ahead? Do you think that you'll be able to hire more, and how do you plan to improve the agents' efficiency? Abhijit?
For the agency, we will continue to remain focused on agency channel with some higher engagement with our individual advisors. We are making some investment in terms of hiring more people at select locations as required, and there is some analysis going on to do better upselling to the existing customers of those advisors, and we are working on that to aid them in improving their business performance.
And lastly, on the group savings, how does the sensitivity is there?
Sorry, you'll have to repeat that.
Not clear, please. Yeah, I'm asking, sir, group savings, how is the interest rate sensitivity in the group saving segment?
It's typically higher than the usual kind of business. On the EV side, because you have backing assets, so obviously that asset is mostly debt, so that is sensitive to interest rate. And going forward also, future profits also, because it's a spread business, so it's sensitive to interest rate changes.
So that is the reason why you have such a high sensitivity to interest rates. Because you have a very high share of group savings.
Sensitivity to interest rate is, I think, somewhere around 1.7, 1.8%. So it's not particularly high.
Okay. All right, sir. Thank you so much.
Thank you.